Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic, is there really a TINA factor in equity? Most investors who believe in equity tend to think that other asset classes don't merit the same attention. We somehow think that equity is a superior asset class. While equity does have its merit over other asset classes, it does not translate to being a superior asset class at all points in time. There are points in time when other asset classes are superior. For example, post the quantitative easing that we saw after the global financial crisis, gold turned out to be the best performing asset class. Post the crisis in India in 2012-2013, debt turned out to be a very good asset class for a period of time. If you look at real estate, it has long extended cycles, and for 3 or 4 years in those cycles, it performs exceptionally well, and for long years, it remains out of favor. Equity itself is a very cyclical asset class, and how it benefits you depends upon how you are playing the cycle. So, every asset class has cycles. When equity is closer to the peak of its cycle, one must look at the relative attractiveness of other classes, whether it is real estate, or gold or debt. One must evaluate the relative merits of other asset classes. The equity investor generally does not do this, and that leads to significant drawdowns in his wealth in every cycle. If you really want to avoid that, when equity is doing very well and the economic perspective and forward indicators don't look all that great, you must consider some risk mitigation. When equity is at a peak, it also gives you an opportunity to take some capital towards safety. Most of us fail to do this for the simple reason that we think we are idling money or we are moving money to an asset class with lower prospect. We don't think of the benefits or the importance of protecting capital. But that is as important in equity investing as it is to generate capital. We all talk about Warren Buffett. We all talk about how he takes advantage of every single crisis. Where we fail as investors is in understanding how he prepares to take advantage of every crisis, and that preparation mantra of Buffett is very simple. When the markets are overvalued, he takes money from equity and keeps it in the most liquid instruments. That is something which other equity investors have not proved to be good at doing, and that is something that this current cycle is once again giving us a chance to try out in our investment strategies. When equity as an asset class looks extremely expensive, instead of struggling to find opportunities within an expensive equity universe, it may be a better strategy to take a little money off and keep it in the most liquid instruments, waiting for the opportunity. If you look at some of the best portfolio managers of 2020, they had money which they were able to deploy at the bottoms, and that explains their performance. In every cycle, people who keep money ready for an opportunity tend to do far better than those who remain invested. With the kind of volatility that we are going to see in 2021 and beyond, it makes sense for us to think beyond equity and look at the alternatives. There is no alternative, or the TINA factor is not the best way to look at equity. Equity needs alternatives, and we must think beyond the TINA factor in equity. If you like this video, I would request you to share it with your friends who are avid equity investors and wealth creators. This is a perspective they may find interesting, and I would exhort you to stay the course with I Thought Wealth. Thank you very much.